Look, I'm a firm believer, Brandon, that we live in an amazing state. And there's this gigantic faucet turned on of people leaving California and coming to our state and the surrounding states. And that is causing tremendous growth on the residential side. And my business being retail chases the rooftops.
The end investor, you got to negotiate with them. Are you going to buy it, with a 6% rate of return or a 5% rate of return? Some people say like, well, that kind of seems like a small difference, Brandon. It's 1%. It's like, it's nearly $1 million.
So we're in a spot where if you can hold anything for long enough, you generally are going to be okay. It's just making sure that you've timed that exit correctly.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Tell everyone really quick, like, what is your craft? What have you done throughout your career? So far, and what are you dialing those 50 hours in on right now?
Yeah, I started as a retail tenant rep broker in 2002. I was representing brands like Wendy's and Starbucks and Wells Fargo and all folks that had drive-thrus. And then we were doing a whole bunch of other non-drive-through work as well. Dollar Tree. We had a bunch of Verizon people we were working with for a long time. And I kind of fell in love with drive-thrus right out of the gate. Just something to do with the way, the pickup window worked and kind of flowing traffic in and out of the building. It's my nerd craft, if you will, and the thing that I get fired up about. And so that's where I honed in on pretty quick. I still own a brokerage company today. We have 27 agents. We cross all disciplines of commercial real estate. We own a property management company, and we manage about 4 million square feet of property, 130 properties kind of throughout the Intermountain and desert states. And then I run our ground up retail development team. And so right now we're actively trying to figure out how in the world to solve any of these pro formas, building new buildings. It's been 5 straight years of just absolute pain trying to figure out how to solve pro formas. And we're going into the 5th year of that. So it's just a lot of fun at the moment.
So tell me a little bit more about that. Like, what do you mean by trying to solve the pro forma? What's the constraint or the issue you're running into?
Yeah. So just, imagine that you're working with a retailer like Dutch Bros, for example, is one of our good customers, and we like working with them. So we're out and we're finding the next good location for Dutch Bros. Site comes in, broker brings it to us. We find it, however we come up with it. And, it's whatever, $800,000 to buy this pad. And it's a piece of land. Well, it's our job to figure out what we can deliver a functioning Dutch Bros building to Dutch Bros to, and then what they should pay us in rent. And so basically it's on us to solve the math equation to figure out, do we have to pull a sewer line from 800 feet down the street and then run it to the pad, or is already sewer in front of the pad? Is there water there? Is the water adequately sized? Is the sewer adequately sized? Is the storm drain adequately sized? What are all those costs to get all the kind of utilities on and off the site? And then we have to figure out what it's going to cost to build the building, what our time frame is going to be to build the building, and then what all of that costs, and ultimately put all of that in a pro forma. And then we're trying to solve that pro forma to a yield, right? So, whether for example, a lot of those get done right now at like 6.75% returns to somewhere in the 7.5% return range. And then we punch out what a projected rent is, and we go to Dutch and say, can you pay this here with what you think you can project in sales? And then they say, yes, that works, or no, it doesn't. More often than not, it's no, it doesn't. And let's massage numbers on both sides. And therein, starts the beginning of the process to try to figure out how to get that store open.
So you're typically, your process in the deal starts once a broker that already has a piece of land for sale approaches you and says, hey, we've got, this piece of land coming to market. Somebody owns it right now. They're looking to sell it. Chris, you've got a depth of clients and opportunities. Is there anything you think you could do with this land? And you don't even that would maybe want to buy it. Right? Like am I understanding that correct?
Yeah. Yes.
Okay.
Or one of our dirt dogs, on our team members, or one of our dirt dog, friends outside the office that had this dirt dog thing's kind of got a little wild. which is entertaining. There's a lot of people out there that are part of the dirt dog pack right out there.
Sure.
And so, just a lot of sites come in every day. And I would say we spend most of our time sorting through who could we put on this pad. It's still the hardest thing to do in the commercial real estate business in retail. There's nothing harder. I mean, and it doesn't really matter if you're leasing, shop space like next to a grocery store, or if you're leasing a shopping center that has a Target in it. The hardest thing to figure out is who do you put in the space. And the reason why is because usually you're not working in your home trade area. And so whatever trade area you're working in, you don't know it as well as the one that you shop in every day of your life. And so it ends up being one of the hardest components to figure out who goes there. So we see all kinds of incredible land sites. And 9 times out of 10, we're looking at it and, on a good one, and we're saying, boy, this really, hits the metrics. You got good daily traffic in front of the site. You've got good access in and out of the pad. You got good co-tenancy. Maybe you got a Trader Joe's next door. You got a Target. You got a Costco, whatever. This is a great site, tremendous site. But what do we put here, right? And if we don't know, it doesn't really go any farther than that. But once we figure out who should be there, and a lot of the time when those sites come into us, the person that is bringing it in, whether it's our folks or somebody outside, a lot of the time they're saying, hey, I think this works for X. Now, if they can give us that direction, we are way more effective because we can get a hold of X, whoever that retailer is, inside of 24 hours. And we can usually get a pretty quick decision.
So once you get to that point and you're trying to work on the pro forma, like how long does it take you guys to turn around a pro forma? So somebody says, hey, I think this spot's really good. And this is a great spot for Dutch Bros, I think. I don't know anything because I'm just a guy selling the land, but I'm going to pitch it to you as, Dutch Bros, great spot. And you guys got to go call it Dutch Bros, but I can't imagine that you guys just spin your wheels or waste Dutch Bros time picking the phone up for every piece of land you guys get pitched, right? You got to put that pro forma together and see if it's even somewhat in the ballpark. How long does it take to turn around a pro forma like that? Like you guys have a pretty dialed science where you're like, oh, okay, we'll punch in a couple things, do a little bit of research here, a couple hours, we got a good pro forma? Or is it like a multi-day process or a lot of people on the team working on it? So it's maybe a quick process, but many man hours or labor hours?
Yeah, it's a great question. We have Dutch Bros projects working in multiple of the Western states to kind of take our home state here with the two of us of Utah and go Utah, Colorado, North and Southwest. We have Dutch Bros deals working in most of those states at the moment. Mm-hmm. And then we've got a couple of Texas things we're looking at. And we've got a project in Tennessee that we're going to kick off construction on probably in about a month. And so we are looking at Dutch sites scattered all over the country with that. Mm-hmm. And it's interesting. The vertical cost is pretty similar in most markets. It moves up or down a little bit, but not tremendously, right? I mean, it's not like you're seeing variables that are exceeding 20% from market to market.
Sure.
The vertical costs are pretty much the same. It's always the horizontal costs and then the fees. And those are the hardest parts of the pro forma. So typically what we do when we first look at a property is we just make an initial assessment that, look, it's a flat site, utilities should be readily available on the road or somewhere close. We're usually looking at something that's in between other things. So that's a safe assumption most of the time.
Yeah.
And then we're making reasonable impact and connection fees. Now, what I would say is reasonable is just outrageous to me on the other side of the coin when I'm looking at it. But, I get it. It costs money. These cities got to run, but some of these fees, sometimes the fees will be more expensive than the site work or the building. And it's just kind of wild what we get charged to go put a new building in. So we'll make a reasonable assessment on fees. And then we'll come back with a number that we think is kind of in range. And that's usually when we'll kind of present and say, hey, look, this looks like a whole. In other words, you don't have sales coverage in here. It's, 3.4 miles from store to the east. It's 4.2 miles from the store to the southwest. And there's really nothing to the north. So this looks like, the next major intersection in the path of your progress. We'd like to put it in front of you and see if we can do a Dutch here. What do you think? And so that math we can usually put together pretty quick, hour or two. Then when you get it dialed down, when they say yes, The next step in the pro forma will take usually, weeks, right? Sometimes a couple of months.
Yeah.
So
So when you get to that more rigorous sort of due diligence and dialing in that pro forma, what are the common hand grenades that get in landmines that come up in the project, right? Like I see on in residential real estate down here in St. George, like all the time, there's just weird zoning stuff. Impact fees in particular can be like crazy big. Or if property's got to come out of a green belt and all of a sudden there's tons of back taxes. What are the big things that pop up on your end and really seem to be, for lack of a better term, deal killers?
Yeah. On the fee side, traffic impact fees, because we're a drive-through use, we're a heavy drive-through user. Those can really be preventative sometimes, especially when they reach into the couple 100,000 range. Mm-hmm. Connecting to water, connecting to sewer, those are so variable. There's really no rhyme or reason to what they are. You just got to flush them out as quickly as you can, put them in the pro forma and see if everything works. And they're not subjective, right? I mean, that's the fee you're going to pay if you want to put that service in that area. It really just is, it's more a function of getting the Alta survey drawn, finding out where all the utilities are, figuring out, are you going to have a lot of import export off the site, pulling dirt on or taking dirt away. That'll get you. Those are costly. Obviously, if you have to put a bunch of retaining walls in, that gets expensive. But it's getting that Alta survey done. That takes 3 or 4 weeks. It gets done. You get a site plan rolling. And then it's still, this is where it's just always typically somewhere like 6 to 10 weeks to kind of figure out what everything's really going to cost.
Yeah.
And it's the problem we're having right now on most sites. It's just it's the same pressure we've been having on constant repeat since, spring of 2022, when Jerome Powell started raising the interest rates. As the interest rates rose, we had a pretty robust sales market on the back end. Mm-hmm. And so, if you were in market, Brandon, to buy a Dutch Bros as an investment property, and, you're not running the Dutch Bros, but you just own the real estate and then they rent from you. And you were looking in market, it was a very robust market. It was competitive. It was more of a seller's market than it was a buyer's market. And then what happened as the interest rates rose, everything in our world gets valued off cap rates, which is the unlevered rate of return. And the cap rates sort of trended upwards generally. They didn't quite, trend as much upwards as what the interest rates did. Yeah. And so that's just left this weird world where investors are unsure. It's not healthy for the markets because we don't have as many investors as we need. And so it's moved a little bit more to a buyer's market unless you have, just the right location, right piece of real estate, something that's in a home run area. But for the most part, it's kind of turned into this environment where there's been more Dutch Bros available for sale at all times generally than there has been buyers available to buy them. Now the inventory's finally started to taper off just a little bit over the last few months. But with other tenants like Starbucks that has like a less desirable lease because they have a double net lease, mm-hmm. It's still building. Their month over month inventory volumes are going up still, which is a real problem if you own a Starbucks and you're looking to sell right now.
Yeah. I think just to clarify for anyone listening, a cap rate is kind of like a yield. If you think about like a dividend yield on a stock, or if you think about a yield you get on a bond, and there's 2 ways that your yield goes up, right? Like if they increase the dividend per share, your yield goes up. If you're on a floating, if you own a floating rate bank loan or something and interest rates go up and they have to start paying more, your yield can go up. But the other way that yields go up is like the really uncomfortable way, which is they're paying the same amount, but the yield is higher because the value of your asset went down. And right. and that's what cap rates, I think you're sort of alluding to is, hey, the cap rates went up, which means that the property values came down a little bit, or people didn't want to pay as much for them, right? Like people were demanding, hey, I need to get a better return on my investment when I buy this, which means I'm not willing to pay as much for it. And
great example of that. I don't mean to cut you off. Great example of that. August of 2022, we sold a Dutch Bros at a 3.95 cap. Mm-hmm. Well, when interest rates were, virtually non-existent, it being so low, that cap rate looked attractive at the time. Well, by the time we got done raising interest rates and all of a sudden you could buy 10-year treasuries in the sixes, why would you buy a Dutch Bros at a 395 when you can buy a 10-year treasury in the sixes? Now, most net lease buyers don't ever really think that way, but that's inherently where, the dilemma lied, right? Is 10-year treasuries were higher, so was everything else.
Yeah. Well, it's the risk comparison, right? So 10-year treasuries viewed as the risk-free rate. I fundamentally don't agree with that. I think they're actually quite risky. But from a cash flow fundamental perspective, that's typically use your benchmark. So as interest rates rise on treasury yields, kind of a lot of other things go with it. And as the yields go up, oftentimes it means the prices are going down. But what's interesting is, Dutch Bros is still operating, right? They're still like a great business. They're interested in opening more locations. There just seems to be this disconnect between, the cost to build, and then the cost to finance, right? Because most people are going to own these actually not unleveraged, but they're going to own them leveraged. Typically would be my assumption. Correct me if I'm wrong there at all.
No, correct assumption. So as I'm solving my pro forma, I'm trying to solve to my unlevered return up here.
Yep.
And then I'm trying to project my cap rate as being lower than that down here. So in other words, the cap rate that I'm going to sell it for. So if I'm developing to, for simple math, if I'm developing to a 7 up here, then I'm hopeful that I can sell it for a 5. And that 2% spread is my profit as a developer.
Mm-hmm.
And so basically the whole market has been out of whack since the interest rates raised. And, going into this year, I think the general investor sentiment, or at least what, a lot of the financial news people were talking about as we wrapped up and figured out who our president was in November, and we were going into Q1, a lot of people just kept coming with the same narrative is we're going to see easing on rates. We're going to see more stability come into the markets, and we're in May and we haven't really seen either. Right. We've seen flat rates, and we definitely have not seen more investor sentiment, at least not evidenced by the fact that we're seeing properties move, quicker than they were previously. It's just been kind of the same.
Yeah. It's, the disconnect really, I'm trying to think of like a really simplified or easy way to communicate this, but I'll just take a pass at it pretty rudimentary here. It's like the disconnect really starts with the landowners sometimes, because they have this asset and, they want to sell their asset for top dollar, just like anyone else. And it's been worth this great value. And a lot of landowners, and again, like step in if I'm wrong, I'm shooting from the hip here a little bit. They don't have a massive amount of leverage on land typically. And so they're saying, hey, I want this for it, but I'll just wait till I get it. I don't have to sell this piece of dirt, right? They're not making any more vacant lots on busy corners in Salt Lake. I'm not going to give it away just because interest rates are high today. I'll just wait till Dutch Bros raises their prices enough and can just pay more rent and justify a cap, more affordable cap rate in the future. And then I'll sell it to you and you can do your project, right? But I'm not going to cut it in half today just because interest rates are high and Dutch Bros isn't going to pay a higher rent, right? Like that's essentially I'm not saying they're wrong for that. That's where the disconnect sort of starts, right? Is like in the valuation of the land. And then the second, I think, big hurdle in the whole process is the vertical build costs and the tailwind for commodities pricing, right? Like, they're not making any more land, and commodities are in what I believe to be a secular bull market, essentially. Like I think there's a big tailwind to commodities price across the board, which means the copper to run for the wiring isn't getting any cheaper, and the aluminum for the studs isn't getting any cheaper, and the concrete's not getting cheaper. And so you have all that. So even if interest rates are high, the build materials aren't getting cheaper and the land's not getting cheaper because it's somewhat scarce, like maybe would be the way to say it. And so now you're just left with, okay, so who gets pinched, right? The end investor has to have a lower return on their investment. The developer has to make less, or Dutch Bros has to pay more in rent. And that's the constraint that you're sort of having to figure out how to massage, right? So that it becomes a win-win for everyone involved.
Yeah, it's a teeter totter for sure. There's a third bucket in there for sure, which is site work, right? And the labor specifically on the site work.
Yeah.
That's another. I'm in a low coverage business versus a res business, right? Where a lot of your vertical construction costs are the majority of the project. In my project, 9 times out of 10, the cost to improve the land and connect all the utilities is more expensive than it is to build the vertical structure. And so that's one more bucket that causes another pressure. But yeah, that's the teeter totter. The tenant can only pay, X% of projected gross sales.
Mm-hmm.
For most retail concepts, it's usually about 8 to 11%. In the coffee world, that's typically 9.5 to 10% for most retailers. It's kind of a standard, but each concept's a little bit different. But so figure about 10%. So, if I'm proposing a rent to Dutch Bros, it's 100 and let's see, their average store unit volume is doing 1.95 million when they reported that at the end of the calendar year. And so figure that they can afford about 195,000 in total occupancy cost. And so, they can pay me usually about 160 to 165,000 in rent. And then they have to save some for taxes and insurance and, the rest of their operating cost. And so that's kind of how the equation works. They need to be there to make money. It's important that they make money so that they keep the store open. And so, yeah, right now it's just the equation's getting squoze at every angle, and it just makes it's a lot more intense. So the buildings that you see that are coming out of the ground, there's usually really good purpose behind them. They typically serve a good, metric for the retailer. They definitely are feeling bullish on them because, most of these that are getting approved and open today, they have to put a pretty good, healthy projected sales on there to make the rent work.
Yeah. Yeah. And so I just did like some quick math, right? So if you say, okay, 160,000 for an average Dutch Bros in rental income, and then it goes back to just to like close the loop on the cap rate thing for people. So at like a 6.5% cap rate, you're like $2.5 million, right? Just shy of $2.5 million. At a 5% cap rate, you're at $3.2 million. So you can go back and like, that's where the cap rate comes into play. It's like, so if you're the one now building the Dutch Bros and you got to sell it to the end investor, and the end investor, you got to negotiate with them. Are you going to buy it, with a 6% rate of return or a 5% rate of return? Some people say like, well, that kind of seems like a small difference, Brandon. It's 1%. It's like, it's nearly $1 million. That's all the profit margin that's probably more than the total profit margin in the deal. Right. So all of a sudden it becomes an unworkable thing. Right. And so, okay. Yeah. So these small variances and having the whole thing put together where I imagine it's really tough to, I'm sure you have a system figured out, like you're good at it, really good at it now, but it's like no small thing to find the deal, line up the tenant that's going to sign the lease and be committed to it and operate a business out of it. And so they got to open a whole business and operate a whole location there. And then also find the end investor that's going to buy that property once it's done. And in the meantime, carry the build costs or manage the project along the way, which is, months and months of, constant slight uncertainties, right? Popping up. This is a huge task.
Yeah, it's stressful. It's like anything, right? I mean, it's intense all the way around the horn. And we would prefer really to hold a lot more buildings. The problem we've got right now is if you look at long-term lending rates, because the interest rates are still so much higher, it makes virtually no sense whatsoever for us to hold any project. And that's just simply put, the average cap rates for most of these tenants is, 150 to 200 basis points lower than what a long-term lending rate is.
Yeah.
And so in that environment, there's no margin to hold, right? So if you were going to go to hold, you would then have to actually put even more equity in than you otherwise would.
Yeah.
And when you put that additional equity in, your cash on cash return shrinks, not increases, because of the debt. It's a negative yield on the leverage. So it makes, literally no sense whatsoever to hold any of them. And so, notwithstanding that, I think what we've tried to do over the last few years, we try to really just identify first-class operators and the people we want to grow long-term with over the next decade, and kind of hone in and figure out how do we deliver your building to you exactly how we want to, deliver it? And how do we make sure our teams are communicating well with each other? How do we get a store open and as, quickly and efficiently and economically as possible? And so we've just really been strategic about the kind of deals that we're trying to accomplish.
Yeah. So let's talk really quick. Like you have this, when you talk about strategically focusing on the right deals, you've found this niche, it would appear, in drive-through, right?
Yes.
Congratulations. You're the only person I know that has specialized in drive-through commercial real estate. And being in Utah, I know an unreasonable amount of people involved in real estate. So like, what is it about drive-through that, is intriguing to you? Like, why do you think this is a good opportunity for investors, or what is fun about it to you? Like, why drive-through real estate?
My grandfather was an oil and gas landman and spent his time chasing mineral tracts that were in the path of production. And so I think, I kind of have that land bug anyways to go find the next deal. And he was a absolute deal junkie. He diversified in commercial real estate and built a couple of RBs in the 70s that we still own. And then my dad was a Albertson shopping center developer. And, the difference there is I would watch him take, 4 to 10 years to get a project fully built out and done. The shopping center business is a very slow, methodical business. And like most kids, you look at your parents and say, I know how to do this better than you do. And I also have extreme ADHD. And I thought, I just need to do it faster, not better. I just need to do it faster. I can't do it. I can't handle eight to 10 year projects. It will never work. And so I thought, rather than do the whole shopping center, why don't I just go do one pad in front of the shopping center? And maybe I don't make as much spread as the shopping center developer does. But if the developer can sell the pad to me, and clip a land price for them that's 80% of what the end price is going to be once I'm done with it, but they still make a really healthy spread by just flipping me the land, there's a business model for them too. And so that's how we make our money. We go in, and in most cases, like my St. George building, we've just finished up down there by you, the Starbucks there on Mall Drive by the Lynn's grocery store.
Oh, it's right by my house. Yeah.
Yeah. So I bought that pad in between Quick Quack, and then the pad to the east of us is planned to be a KFC restaurant. And we bought that. It was kind of the last remaining pad on the frontage. And we knew that Starbucks had a need to be there. And so we thought, look, let's program this in. And when we started doing that, we figured there was room for a couple more tenants. And so we added in, and we've just signed some leases with a dental tenant and then a men's grooming, barbershop that's going in there as well. Mm-hmm. And so, we're able to go in and out, and that project took a little bit longer because we had some additional, kind of considerations to work through when we were doing our site planning and building design. Yeah. But even on like a longer project, it's like 2 years in and out. Right. And for us, that's on the longer end. The quicker end, we can build and get a Dutch Bros done in about 4.5 months and exit and sell.
That's pretty quick.
Yeah.
Yeah, that's pretty quick.
Yeah, you got to be, all conditions got to be right on those fast end. But we bought a piece of land in Allen, Texas, January of last year, third week in January. And we built the Dutch Bros. It opened the first week in June, and we sold it the end of June.
Yeah. That's quick.
Yeah.
Impressively quick. So, like, one of the questions I get all the time is people, like, my clients are always asking, like, oh, I want to invest in real estate. I want to invest in real estate. And I have tons of clients that do invest in real estate. And there's never a shortage of excitement around real estate, especially here in Utah, right? And one of the things that I think some people underestimate is like the diversification within real estate, right? So like, what kind of real estate do you want to own? Why do you want to own it? But for people that are looking for a passive diversifier in their portfolio, I think commercial real estate, particularly triple net, can be, pretty attractive, right? But how does somebody that hasn't owned that before get involved with, you know, like you don't just like Google, I want to buy Drive-Thru, Dutch Bros, Triple Net, who do I call, right? And you don't have like a, you know, paid Google, you know, advertisement. Call me, you know. It's like, where does somebody start? Like, you know, do they, and what kind of resources do they typically need to bring to the table, right? Do they go and talk to their banker first and make sure they're approved for a certain type of loan, or do they tend to need cash? Do they, you know, are a lot of these deals syndicated or not? Like what's the situation there, right? What kind of advice, or not advice, but just words of wisdom do you might have for somebody that's interested in the space as an investor?
It always makes me laugh when I'm like flipping through Instagram and then I see an ad for, you know, an offering. And I think it's just, it's an interesting way for people to advertising, GPs that are looking for money for their syndications. Inherently, everybody like me, you know, there might be one developer doing it with their own money, but for every one that's doing it with their own money, there are 50 others that just simply put have more projects than they have money. And so that's what ultimately causes people to syndicate or go out and raise money from, you know, limited partners, investors into their transactions. And that's what creates the marketplace for that. So you know, I talk to people all the time that are interested in it. And I think the biggest thing is just finding anybody in your life that's in commercial real estate and ask them, you know, because they typically know the different players that are out there that are raising money for their deals and what asset classes that they're in. And so most people that, you know, are in commercial real estate typically have a decent handle and decent understanding on that. I would actually probably be a little leery of somebody if they had you know, if you Google search that and it immediately pinged back, it would probably make me a little bit anxious.
Yeah.
You know, we syndicate deal by deal. And so we just raise money deal by deal. Each time we do one, we create a single purpose entity, and then we raise the money and we do the deal, and then we exit, and then we terminate the, you know, LLC as quickly as we can after, and, you know, just wrap up the affairs and move on to the next one, and then use a brand new entity again. And so that's how we operate. We have, you know, fairly tight friends and family pool that has kind of come in. We've opened that up over time, and we've had a few new people coming in for the last few years as our project pipeline has increased. We've needed a little bit more money than our typical friends and family network has worked. I find most of our investors come as referrals from existing investors. Yeah. And so, you know, I think what's key, it's a great way to diversify your wealth and your portfolio, is to get in with a couple of good, you know, one or two or three good, you know, commercial real estate general partners, people like me, and especially if it's an asset class that you like, and kind of spread it around. And to your point, you know, these are different. It's similar to buying a bond and a stock. It's similar to buying different kinds of stock, whether it's an index or an individual company. In my world, I'm banking on an individual company paying me rent. So
Mm-hmm.
I'm banking on, you know, Dutch Bros corporate functioning and working. And so we are tracking financials for those companies tightly.
Yeah.
You know, because it's critical that they're working and it's all functioning right, and that we'll get rent. But, you know, the next person, you know, up that you might talk to that's a general partner might be building townhomes for rent. And then there might be somebody else out there that's building storage, and you might choose to invest with all of them. And which I think is a good idea, to kind of spread it around, because then you're kind of building yourself a diversified portfolio of commercial real estate.
Yeah. Yeah. I mean, like, we're going to look, if you get in these type of deals, you should probably look up what an accredited investor is and make sure that you reasonably meet those standards. But what are people that are doing these deals, what kind of cash are they normally looking for, right? Like, cause I'll get sometimes people that are like, hey, and this is the just ironic part of the world in which I live. All people that'll be like, hey, I got a bunch of money and yeah, I want to get investing. I'm like, what do you got? And they're like, 25 grand. And I'm like, okay. And then I'll have people like, yeah, I've got a little cash, not much, but I've been thinking maybe I should put it to work. And I'm like, what do you got? And they're like, $5 million, it's,
That's always the one that just crushes you, right?
Yeah. And anyway, so it's always funny. It's just perception, right? It's just perception relative to what they have had or experienced in life, or somebody's own personal, level of humility, maybe, whatever it is. But I think sometimes putting figures, like more, a better guideline to stuff, helps people give an understanding of like, what does it take to be at the table, right? Because sometimes like there's just great opportunities out there, but they do come with a fair amount of risk sometimes, and you need to just earn your spot at the table, so to speak, right? So if you start talking about diversifying and you're like, well, okay, so maybe I'm going to, get some storage investments. I'm going to get involved with some multifamily, and I'm going to get involved with a couple drive-through properties. And all of a sudden, to me, and correct me if I'm wrong here, it's like that's a couple $1 million of capital likely to be at the table.
Yeah.
Not each one, but collectively, if you're getting that diversified.
It just depends, right? It depends on size, right? If you're working with, if you're interested in buying into apartment complexes, right, where somebody might be building 200 to 400 apartments at a time, and then all the amenities attached to that, pool, pickleball courts, etc.
Yeah,
something like that, they're probably not taking an investment under $500,000, right?
Yeah.
Whereas for us, most of our capital raises are right around like 900,000 to 1.3 million. So I don't have a 500,000 minimum. So it just kind of depends on the deal size.
Okay.
I would definitely say though, you're definitely gonna want to be around 100,000 to 250,000 as you're starting to do your first few investments. And I know that number's higher, but really it's a lot less than what the full $1.25 million or $1 million that it would take to do my deals, which are on the smaller end.
Yeah. Yeah.
In the commercial real estate space, just by nature, because it's just one building, one tenant.
Yeah.
But you got to be in about that size range. It seems like the general rates of return for most asset classes are about 6 to about 9%. Pretty abnormal to see anything higher than that on kind of your preferred returns. And I know there's really no market for this, but just kind of talking to peers and looking at other people's pitch decks, it seems like that's about the range. Most people typically project anywhere from like a 16 to maybe like a 22 or 23 or 24% IRR. When you start seeing numbers that are out of whack with that, you just got to start asking yourself, what is this person doing that's that much different than everybody else? And, but that, when you're in that range, that's usually, should at least roughly identify that you're in the right ballpark with somebody, at least a GP that's putting out numbers that are illustrating what, where the market generally is right now.
You're saying 6 to 8 on cap rate or yield, and a total IRR over time of, you said like 16 to 20.
6 to 9 on cash, 16 to like 22 to 24 on IRR.
Yeah.
I think it's almost never that you see a deck that doesn't show some cap rate compression over time. Now, what we're seeing is a lot of the decks now are not 3-year decks or 5-year decks. It's a 7-year hold, right? And so,
yeah,
look, I'm a firm believer, Brandon, that we live in an amazing state. And we're surrounded by many amazing states. And there's this gigantic faucet turned on of people leaving California and coming to our state and the surrounding states. And that is causing tremendous growth on the residential side. And my business being retail chases the rooftops. So once the rooftops go in, I'm right behind it. And we've got to bring the retail services in attached to that.
Yeah.
And so we're in a spot where if you can hold anything for long enough, you generally are going to be okay. It's just making sure that you've timed that exit correctly. And right now we're in a short-term period where interest rates are still a little weird. Investor sentiment hasn't really come back like we were all hopeful for this year in 25, but it will change. It's been like this, and it's been the same way for a couple of years, and nothing stays constant forever. So eventually it'll change, and the tide will move the other direction. And whenever it does, if that's timely and you've timed your exit appropriately, you ought to be able to punch out some nice, IRR numbers and deliver to your investors a good return as you go to exit the asset.
Yeah. I always laugh. There's someone here in Utah, and you might know who this person is. I won't call them out by name, although I probably should. I'm fairly convinced they're absolutely committing fraud. It's like shows like right on their like Instagram page or something. It says like, I help like wealthy young people achieve like something like, I don't know, like 6% return per month, and I'm like, oh, good luck. It's like mathematically possible, I
always just default back.
It's like,
what is this person doing that's that much different than everybody else? And if you can truly come up with a reason in your head for why they are doing something that much different than everybody else, the rest of the world is growing at like more of the range of what we're talking about, 6 to 9% leverage cash flow.
Yeah.
And, high teens IRRs.
Yeah. Which is like a phenomenal return, right? That is the return that is, I don't want to say expected, but for the given amount of risk that you take as a leveraged investor in a private asset class, like that's a kind of like ballpark return you would sort of be hoping for, right? Because anything less than that, you tend to not look that great just compared to like public liquid alternatives. You know what I mean? Mm-hmm. And so it's just funny. There's always this world where people want to hit home runs. They just want to absolutely hit grand slams, and they look in all the wrong places for them. Whereas I think like real estate, you can like, to me, real estate is all about like the doubles and maybe triples, like hit a more consistent, like some people say singles and doubles. And I think like real estate, if you're smart about it, I've observed that you can relatively consistently hit doubles, but you have to be willing to say, I'm not going to swing at that pitch. Right. And sometimes I'll just strike out. Sometimes I won't get at bat as much or whatever it is. But like when you swing, you can make a nice swing. But you got to be selective.
Yeah. There's nobody that's getting, wealthy and retiring overnight. It doesn't happen that way. And, here I am, I'm sitting right in my 23rd year of my career. Mm-hmm. And I feel like I'm just starting to figure out how these deals work for the first time.
Yeah.
I've done thousands of them, literally.
Yeah.
You rattle off a Chick-fil-A in the Western US, and I can pretty much tell you the cross street closest high school, what's going on, or roughly what the volume is, or I can find the information out with 5 minutes or less. And, so there's a lot of knowledge in that head. And I feel like I'm just coming into the knowledge of what really goes into making one location better than the other.
Yeah. Yeah. Well, you're a little bit further in your career than I am. So you might be, your time horizon on this might be a little bit more extended, but I'm always like, if you don't look back, a year or two ago and think like, wow, I didn't know friggin' anything back then. How, like, man, I was dumb back then. Like you should be a little bit scared. Like there's so much to learn, particularly in the world of finance, whether it's through the real estate side, commercial development, capital markets, whatever it is. There's a lot to learn. And, Warren Buffett, he's like, 97, he's still kicking, man. Cause he's still loving it. He's probably still learning every day.
Yeah. And it's, you got to enjoy the ride, find something you like to do and get after it. And, I was fortunate to find drive-thrus and just get to a nerd out level on drive-thru that is truly next level and dive in fully right out of the gate. And I love it. And it's been a fun path for me. So figure out whatever it is you like and you dive in.
Yeah. Yeah. Well, hey, I appreciate you sharing some wisdom and knowledge with everyone today. Hopefully that gives everyone a little bit of insight into the commercial space, commercial development, and the world of triple net leases, particularly around drive-through real estate. Chris, if anyone wants to get a hold of you or your team, what's the best way for somebody to reach out? Where can they find you?
Yeah, you can almost at this point Google Dirt Dog and find us that way. But if it's not that way, you can find us on our website, Forza, Forza, commercial.com.
Very cool. Well, I appreciate you taking your time, and I look forward to connecting with you next time you're down here in St. George.
Yeah. Let's do it next time. Let's look it up and love to get together with you for a few minutes. Thank you.